Stock Market 101. How to get started and make your first investment. Did you know that over 50% of American households own stocks? The stock market is a powerful tool for growing wealth, but many people feel intimidated by it. They think it's something only the rich or experts can navigate. The truth is, you don't need to be a financial guru to get started. With the right knowledge, anyone can invest in the stock market and begin building their financial future. In this video, we're going to guide you through the basics of the stock market and show you exactly how to make your first investment. By the end of this video, you'll understand what stocks are, how the market works, and most importantly, how you can start investing, even if you have no experience. So, stay with us until the end, and you'll not only have the confidence to take the first step toward investing, but you'll also be equipped with the tools you need to make smart choices along the way. Let's dive in. 1. What is the stock market? Before we get into how to start investing, let's first understand what the stock market is. Simply put, the stock market is a place where individuals and institutions buy and sell shares of publicly traded companies. When you buy a share of a company, you're essentially buying a small piece of that company. As the company grows and becomes more valuable, so does your investment. The stock market is made up of various exchanges, with the two most famous being the New York Stock Exchange, NYSE, and the Nasdaq. These exchanges are where stocks are listed and traded. Companies like Apple, Amazon, and Google are all publicly traded, meaning you can buy shares in them and own a piece of the company. But remember, when you invest in stocks, there's a risk involved. The value of your investment can go up, but it can also go down. This is why understanding the stock market before you dive in is essential. 2. Why should you invest in the stock market? You might be wondering, why invest in stocks instead of just saving money in a bank account? The simple answer is that the stock market has the potential to give you much higher returns than a savings account or even most other forms of investing. Historically, the stock market has provided an average annual return of around 7–10%, which is much higher than the interest earned in most savings accounts. Over time, these returns can compound, meaning your money can grow exponentially. For example, if you invest $1,000 in the stock market and earn a 7% return each year, in 10 years, that $1,000 could turn into $1,967. In 20 years, it could grow to $3,869. This is why investing in stocks is often seen as one of the best ways to build wealth over the long term. Another reason to invest in stocks is that they give you ownership in some of the world's most successful companies. Owning a share in companies like Microsoft or Tesla means you get a piece of their profits, often in the form of dividends, and you can benefit from the company's growth as the stock price increases. 3. How does the stock market work? Now, let's break down how the stock market actually works. When you buy a stock, you're essentially purchasing ownership of a small part of that company. The stock price represents how much one share of the company is worth, and it fluctuates based on various factors, such as 1. Company performance. If a company is doing well and making a profit, the stock price is likely to rise. 1. If a company faces challenges, its stock price might fall. 2. Market trends. The overall economy or market conditions can affect stock prices. 2. For instance, if the economy is doing well, people tend to invest more, which can drive stock prices up. 3. Investor sentiment. How investors feel about a company, an industry, or the market in general can drive stock prices up or down. 3. This can sometimes be based on news, social media trends, or general market speculation. Stock prices are constantly moving during market hours, which is typically from 9:30 a.m. to 4 p.m. Eastern Time, Monday through Friday. But don't worry about trying to time the market. This is where long-term investing comes into play. Most successful investors don't buy and sell constantly. They make investments and hold onto them for years, letting the power of compound growth work its magic. 4. How to buy stocks. The basics. To start investing in the stock market, you'll need a brokerage account. A brokerage account is like a bank account, but for your investments. Through this account, you can buy and sell stocks. Here's how to open a brokerage account and start buying stocks. 1. Choose a brokerage account. There are many online brokerage platforms to choose from, such as Fidelity, TD Ameritrade, Charles Schwab, Robinhood, and E-Trade. When choosing a platform, look for one with low fees, a user-friendly interface, and helpful resources for beginners. Some platforms, like Robinhood, offer commission-free trades, which can be a great option for beginners. To fund your account. Once you've chosen a brokerage account, you'll need to fund it. Most brokers allow you to link a checking or savings account, and you can transfer money into your investment account. You can start with as little as $100, but remember, the more you invest, the more potential you have for growth over time. 3. Research stocks. Before you buy your first stock, it's essential to do some research. Look at the companies you're interested in, check their financial health, and see how they've been performing. You can use resources like Yahoo Finance, Morningstar, or Google Finance to get a sense of a company's performance and future potential. If you're unsure where to start, consider looking at large, well-established companies like Apple, Microsoft, or Coca-Cola, as they are generally considered safer bets for beginners. 4. Place your first order. Once you've done your research, it's time to buy. On your brokerage platform, search for the stock by its ticker symbol, like AAPL for Apple or Google for Google. Decide how many shares you want to buy, and place your order. You'll have the option to buy at the current market price or set a limit order, which means you specify the price you're willing to pay, and your order will only be executed if the stock reaches that price. 5 types of stocks to consider. When you first start investing, you might be wondering what types of stocks to buy. Here are a few types to consider. 1. Blue chip stocks. These are shares in well-established, stable companies that have a history of reliable performance, such as Apple, Microsoft, and Johnson & Johnson. 1. Blue chip stocks tend to be lower risk and can offer steady returns over time. 2. Dividend stocks. These stocks pay out regular dividends to investors, which can be reinvested or used as income. 2. Companies like Coca-Cola and Procter & Gamble are well known for paying dividends. 3. Growth stocks. These are stocks from companies that are expected to grow at a faster rate than the broader market, such as Tesla or Amazon. 3. Growth stocks can offer higher returns, but they also come with higher risk, as their stock prices can be volatile. Conclusion. Start your investment journey today. Starting your investment journey may seem intimidating, but it doesn't have to be. By understanding the basics of the stock market and following a few simple steps, you can make your first investment and begin building wealth for the future. Remember, it's all about starting small, being patient, and making informed decisions. As you gain more experience and confidence, you can continue to grow your portfolio and take on more investments. If you found this video helpful, be sure to give it a thumbs up, share it with your friends, and subscribe to our channel for more insightful videos about personal finance and investing.